Hello, everyone. Welcome to M2uned. This particular episode is titled "The Crypto Outlook for 2025: The Year of Strategic Adaptation." My name is Sudhir Arumugam. I'm the Chief Product Officer at M2, and joining me today are two very senior colleagues: Kim Wong, who is the Managing Director and Head of our Active Treasury, and Jeff McAllister, who is our Chief Risk Officer. Before I get them to introduce themselves, I'm going to be briefly covering what we'll chat through today, and we've got some very, very interesting themes to go through. We'll begin with the introduction to crypto and looking at how we left off 2024 and how we looked into 2025. Bitcoin's adoption among station nates and growth, institutional adoption around crypto, the rise of RWAs, real-world assets, and tokenized collateral or tokenized yield coins, active management in crypto and how that has been viewed and executed by institutional players in the space, the huge growth in stablecoin markets, and the growth of DeFi and AI agents. So welcome, everyone. Maybe I can start with you, Kim. Could you give everyone a background to yourself and then over to Jeff?
Yeah, thanks very much, Sidhu. Nice to meet everyone. So predominantly my career has been in TradFi, but the last 8 years I've been heavily involved in the crypto space from projects to trading, and right now obviously managing the treasury team here at M2. Obviously it's been a very exciting start to the year, a lot of volatility in the markets, and we're looking obviously ahead to the inauguration next Monday of President Trump, and already seeing the market starting to price some of that in already, which is good.
Yeah, thanks, Sudhu. Great to join you today. Also dominant part of my career in TradFi, 25 years plus, but the last sort of 4 years or so in crypto, in a head of risk role, and also previously in a head of markets role. And looking forward to this chat today for sure.
Fantastic. Look, so 2024, Bitcoin started at $40,000 or dollars. It ended at 94,000 US dollars, 125% increase. If we looked at what the S&P did in that same period, I think it was just shy of 30%. Unfortunately for myself, from a TradFi perspective, I was long the FTSE, which I think was up 8% or less during the year, and the pound got kiboshed as well. So thank goodness for crypto. To set the scene, I think Galaxy came out with a institutional report this week. They're calling for Bitcoin up at about $185,000 and looking at ETH up at $5,000. So during the course of this, it'd be very interesting to get kind of your feedback, Kim and Jeff, on what you expect for the market. But why don't we begin with sort of Bitcoin's growth and adoption by nation states? Galaxy, in that same report, said that they expected at least 5 sovereign states to adopt Bitcoin as a strategic reserve this year. How do you see that space evolving? We've got El Salvador and Bhutan so far, but who do you see the key, I guess, sovereigns that might be fitting into that space?
Maybe I can answer that first. So, I mean, with El Salvador and Bhutan, effectively, developing markets, there's obviously a natural demand, to hold a decentralized asset, and obviously, Bitcoin is primarily that asset of choice. Obviously, it's a very volatile and speculative asset, but I think as we are, anticipating a switch over with predominantly driven by the US this time around, I think it could be quite interesting as a reserve asset, which I think a lot of people are talking about, especially if it's driven out of demand from the US side. I think it validates some of the strategy and the moves by the likes of El Salvador and
Bhutan. Thanks, Kim. Jeff, I mean, how much of the price movement so far this year, or end of last year and into this year, do you think has been driven by this strategic reserve narrative?
Well, probably hard to say exactly, but I think certainly the idea of the US having a Bitcoin reserve is probably helping the bid, for sure. Probably putting a bit of a floor under BTC. But I think what we're seeing this year probably is more institutional and private investors coming in and front running that possibility. It's obviously on the table. It was an election platform. So if they deliver it or not remains to be seen. If they do, it's obviously, really, really significant. It's huge. So I think the galaxy number of 5 nation states having crypto assets as a reserve is probably could even be understated if the US actually goes ahead this year, right? So I don't think it's really built into the price yet. To be honest, I think it's there as a bit of a flaw, but I think it's just people front running that possibility at the moment.
Yeah, very interesting. I think one for you, Kim, is we're based here in the UAE, and UAE has been at the forefront of sort of crypto adoption. What is your view on the GCC's position, not just in terms of a strategic reserve, but in terms of crypto and being a regulatory friendly and destination for crypto businesses?
Yeah, I think certainly here in the UAE, very forward thinking and strategic in terms of the asset class itself, and obviously with that the industry here is growing, as we can see, right, as we can all testify to. But I think behind that is really the switch over from essentially oil producing region to one that is more sustaining around or away from fossil fuel burning. And I think crypto and Bitcoin mining and the ecosystem around that makes a lot of sense, right? So that has to obviously be led by regulation. A lot of that regulation also has dependency on the US globally, right? But I think definitely in the UAE there are certainly noises being made, such as sort of a dirham-backed stablecoin that's on the cards potentially for this year, and that's important because of its peg to the US dollar. So I think there's a lot of alignment and synergy, but we also need a bit of a checkered flag or a green flag or red flag, whatever, not red flag, green flag from the US to set us off.
Yeah, no, I do agree. Look, ADGM, who's our home regulator in Abu Dhabi, came up with crypto regulations back in 2018. And they've been very, very clear around this is the rules and regulations for crypto businesses. We welcome you, but this is how you need to come and be prepared and present yourself. And I think that's obviously we've got other regulators in the jurisdiction as well. We have ESCOM, Avara, and that has clearly brought hundreds of crypto firms like ourselves to launch here, either foreign firms, dual licensing, or firms like us who are homegrown, which is sets a really promising trend for us. If we look at the sort of institutional investors entering crypto, I remember back in 2017 when I first got into crypto, I think it was Bitcoin trading around 5K or 10K, and I went to see State Street in London, and they were like, yeah, and as crypto went up that year, I had, I don't know, maybe 5 rounds of meetings with State Street saying, they want to, we really want to get into crypto. How do we do it? What's the best way? Is it ETFs? Is it a spot? And then the minute that crypto collapsed from 2018 into 2019, we never heard from them again. And I guess one of the things that I'm sort of curious this bull cycle is, we have BlackRock and Fidelity coming in through the ETFs, and obviously AUM is growing significantly. For example, it just took 3 months for BlackRock's IBIT ETF to overtake its gold ETF. The gold ETF has been around 20 years. Galaxy, again, in their report as one of their 5 themes, is saying that by the end of 2025, they expect $250 billion in crypto ETFs, which will then surpass all of the gold ETFs. So essentially in 2 years, Bitcoin ETFs will be larger AUM than gold ETFs, which is just incredible. But I guess my question is, what do you guys think about, is this FOMO from just the price appreciation? And if Bitcoin pulls back to 65K, will we still see inflows? And are the institutions here to stay? Maybe Kim first. Or?
Yeah, I think nobody sort of needs to be that first mover, right? So to speak. Certainly not in TradFi. I think in the early stages, it's all about building the ecosystem and the infrastructure, and essentially having the liquidity and also the structure and systems around the product itself to be able to scale. So without that scalability and liquidity, you come across gaps and these liquidity gaps. And that's what essentially has been going on, right, for a little while. I think certainly last year, with BlackRock, really making a big sort of noise around the ETFs. What comes from that, shows in the price of Bitcoin and the appreciation that we saw last year. So again, no, doesn't really pay to be the first mover, but I think definitely we are at a point where essentially with what's going on right now in the US, we're setting the stage for a nice sort of a move, not only sort of higher in the asset prices, but also in the growth of the ecosystem and the industry.
Jeff, what are your thoughts?
Look, I think institutional adoption has a couple of angles. Obviously, what we're seeing at the moment is more sort of from a treasury point of view, if you like, or an investment point of view, which is building. Your Michael Saylor and these guys building up major investments, which is it's almost like an ETF, I guess, but people accessing it as a diversification asset or a treasury asset. But then you've got sort of corporate world coming into Web3 and utilizing Web3 for its capabilities of actually producing applications for building a stakeholder economy and everything crypto has to offer beyond Bitcoin. So that kind of adoption is probably a bit slower and further away. I think the investment adoption side is at some point we will see we'll see institutional FOMO, I guess, and it could be started by the states. I mean, I wouldn't have ever thought it, but you might even see state FOMO if the US actually goes ahead and builds a reserve, right? But it is a volatile asset. People are concerned about that, but there's a lot of points of view where you can say that it's less volatile, less risky than other assets. It doesn't have business risk. There's no risk of poor management like equities. There's no credit risk. Bitcoin can't default. You're not exposed to anybody's balance sheet. It's incorruptible. It's immutable. There's no risk of fraud. It can't be edited or altered or counterfeited, and it's inflation resistant. So yes, it's a bit volatile, but there's a lot of risks that it doesn't have that traditional assets do have.
Yeah, we've got a question from one of the listeners, which I'll jump into. But I think a very interesting stat that I read the other day was that BlackRock in their 24-25 outlook or end of 24 outlook, should we say, showed a very, very interesting statistic around correlation. So essentially for the first sort of half of the year, Bitcoin correlation with equities was up around 65% or so, which is very, very high and very unusual. Towards the end of the year, in the last sort of 6 months, it basically trended down to 15%. So very little correlation, some correlation, but very little. And I think that and they use that argument to say that Bitcoin was an uncorrelated asset, and therefore you should increase your exposure to it from a portfolio management perspective. And their number was around 2%. This is for sort of corporates and high net worth individuals. I guess the question from the audience was, what sort of crypto, what are the primary risks for institutions in terms of crypto exposure, and how should they be mitigating these risks?
Well, I'll start that from the risk point of view, I guess. I mean, right. I think primary risk is, I think, the custody solution. first of all. You know, one of the key use cases of crypto is that it gives you different custodial options. You can self-custody in a meaningful way. However, you know, if you're an institutional player, fund manager, you probably want to consider actually having a regulated or licensed custodian, you know, like M2 custody, for example. But so custody is a key thing for any player to work out how they want to do that. It's very important. And then in the space, you know, we talked before about the volatility. You know, Kim mentioned the volatility, of course, of Bitcoin. It is, but then there's all these other risks that it doesn't have. And then in the crypto space in general, for institutions, you've got a huge amount of counterparty risk that they've got to watch out for if they're trading in the ecosystem. The whole ecosystem is still, you know, largely full of startups. You know, we're obviously fully, you know, we're probably in a fortunate position that M2 is, you know, Abu Dhabi invested. It's got, you know, significant backing, but most of the industry is a startup of some sort or other. So there's a huge amount of counterparty credit risk you have to watch out for out there as well. Yeah, so custody, obviously managing your market risks. The volatility is very different to TradFi, and the counterparty risk is real as well.
Yeah, thank you. Kim, question for you. So Bitcoin is at about, I think, 110 billion in AUM right now in the ETF space. Ethereum's up at 10 billion. Why do you think that Bitcoin has had this sort of massive surge in as an investment vehicle, Bitcoin ETF, sorry, as opposed to the ETH ETFs? Because it's disproportionate to their market caps in the spot markets.
Yeah, I think maybe one reason is because MicroStrategy is not creating a demand for ETH as he is for Bitcoin. But you know, essentially, if you're talking about core decentralized asset, Bitcoin is the asset, right? And I think the focus is always going to be on, you know, it's almost the dollar equivalent, right? The digital asset space in terms of anyone wanting to build a reserve is going to be building a Bitcoin reserve, not an ETH reserve, right? And also the limitation of asset creation is an impact, is obviously a reason for that too. 21 million token, which probably a decent chunk of that has gone missing. So you know, I think yeah, I mean, it's a digital gold, right? Digital gold, Bitcoin, ETH is a digital gas, right? That's what generally people in the industry refer to those two assets as.
Yeah, it's a brand, I guess, right? With a fixed supply, which is the mass two big USPs. When I recently at an ETF conference that M2 was a moderator in Barcelona, I think European Blockchain Convention, there was the ETF panel, and Aberdeen were on it, Bitwise, 21 shares as well, I think. But essentially, there was about 50 or 60 billion dollars in ETFs and ETPs on that panel. And when I asked them about the geographic demand from customers, the Middle East was actually one of the lowest, along with Hong Kong. And so I asked them sort of why they thought that was the case, and I think their view, pretty unanimous view, was that both in sort of Hong Kong and in the UAE, crypto investors were very, very nuanced and literate about what they wanted to invest in. And so this sort of blanket Bitcoin ETF wasn't really as appealing as to, hey, we want Ton or Solana or another coin. And secondly, they were also much more crypto savvy in terms of custodying their tokens as well, which was very different to an institution or a high net worth, you know, in Western Europe or in the US, I felt. I mean, do you see, but yet at the same time, you know, I think, you know, Kim, you and I were in a meeting with a very large bank a few weeks ago, and they were talking about AED denominated ETFs for Bitcoin here. I mean, do you see a big use case for local ETFs?
Me?
Yeah.
Realistically, it's hard to say no or yes, but if you just based on what you're saying about investors in Hong Kong, you're right, they are very savvy, right? I lived in Hong Kong for almost 20 years, so I get to see the sort of the retired grandpas in Citibank, on the terminal, trading their shares. But reality is, the Hong Kong ETF for BTC and ETH has not taken off, and probably won't take off as much as it has in the US, because as you say, they want to be able to trade and day trade their crypto. They want to own their crypto. They want to trade it on platform, and they don't want to pay high fees, and they want that 24/7 liquidity. So potentially it could work. I don't know. We'll have to see.
Yeah. Let's chat about stable coins. Another very interesting space, and then as a subdivision of that, we'll chat about RWA straight after that. But if stablecoin AUM is now north of $200 billion, Tether, which was up at around sort of, I guess, the 90% market share of this, is now at about 2/3 of the market, so still by far the dominant player. And but there are lots of stablecoins being launched because of the demand for them. What are the pros and cons of stablecoins, and how do you see that space growing relative to the virtual asset space? Maybe Jeff?
Yeah, sure. Look, I mean, it's the pros and cons. I mean, I guess it depends where you come from. For the US, it seems to be a very big pro because obviously it's really, we're only talking about US dollar stable coins. I mean, it's kind of the backdoor dollarization of the world. There seems to be very little to no adoption in the other currencies. But so for the developing countries, it's a challenge. If they've got weak currencies, they're being pushed into dollarization of their economy, whether they like it or not. Workers. I worked in Hong Kong as well, but I was also in Southeast Asia in very underdeveloped countries. And workers in those economies typically convert their salary to US dollars cash, like straight away. The day they get paid, they go out and convert into US dollar cash. But now, at least with the cash, they're kind of fairly restricted to keep that US dollar cash in the local economy. But now they can more easily convert it to stable coins, and their capitals can fly away further and faster. It's actually a challenge for developing countries. For the US, it's I think a big boost. Funds their deficit, and but for the consumer, it's obviously just a super convenient product. Probably one of the maybe the second best product market fit in crypto after Bitcoin. And you talk about the $200 billion worth of assets. That's also sort of understates the importance of them, even because the turnover is huge, right? They're
Right.
almost half of every transaction. So yeah, great product. There'll be more to come. There's risk though. If you get into trouble in a stablecoin, there's real risk there as well.
Yeah, I mean, look, I think it's still 90% of stable coins are used for trading purposes, right? So this is the primary use case, and then I think my view on is that for this to grow, and it will grow, remittances and payments are the ones that will fill the gap, right? Because we can't expect stable coins to go to 500 billion on the back of derivatives trading. No, I mean maybe it will, but the point is. Yeah, but I mean, there's limits to scale. It's remittances, here in the UAE, obviously, a massive remittance market. I think it's $45 billion a year, I read somewhere. And that, then there's payments on top as well. So I think, my personal views, I think there's there's room to grow, but it has to be because of use cases away from trading. I mean, within the stablecoin as a subclass, there is obviously yield-bearing stablecoins. I think there's about 7 billion of those now. Athena 6 billion leading the pack. Kim, do you see, how do you see yield-bearing stablecoins fitting in from a growth perspective and use case comparative to Tether and Circle, say?
Yeah, I mean, as we saw, I guess the guys that have been in crypto for the last 2 3 years will remember Luna, right? And that's an algorithmic stablecoin, essentially. So there is a bit, probably still a little bit of a stigma attached to that, but I think generally investors are very short-term memories. So yeah, yield bearing, obviously great. Who doesn't want a bit of yield, right? If you don't have to do very much for it, it's a very good way to earn passive income if you're in the digital space. But obviously, if you're more of a active investor, you probably want to explore better yields. I think in the absence of a liquid tokenized treasury market, essentially, obviously, the yields will be lower. But I think there's also an argument of how safe are these yields in terms of how are the risks and what's the strategies being deployed, how sustainable are they, etc. That's going to be a question.
Yeah, it's very interesting. Another thing that we get inquired a lot at M2, as both of you guys know, is RWAs, or real world assets. I think pretty much every second week we get a visit from someone saying, "Hey, can you tokenize our building and create a market for it?" And of course we were like, "There's lots of buildings, and who's going to be the market maker?" And generally we don't hear back from them at that point. How do you see RWAs, whether it be obviously the tokenized treasury market is successful, but it's a unique use case of it. But how do you see less liquid RWAs emerging in 2025, whether it be private credit, real estate, wine, or assets like that? Maybe start with Kim.
Yeah, I think there is definitely a lot of hype around, it's a buzzword, right? In my mind, we've met with a lot of guys in that ecosystem, whether they want to issue, whether they want to be the vendor in terms of tokenizing the asset. The reality is you do need liquidity, right? Secondary market liquidity is important. The reason, obviously, a big reason for tokenizing assets is obviously, using it as collateral for lending and borrowing. So, potentially with tokenized treasuries, you can do that. But I think tokenizing a building in DIRA and trying to borrow against it may be a little bit trickier.
Jeff?
Yeah, look, I think, well, I often say that we're all NFTs, we just don't know it yet. So, and obviously, I mean, there's different ways to tokenize. NFTs, a way of creating digital ownership in a manner that can be, well, super strong, immutable, and the RWAs, like buildings and so on, it's going to come, but it's going to be a little bit slow, I guess. But ultimately, yeah, you'll get more and more properties available for sale as an NFT. The title deeds will be an NFT, and then you can tokenize those, of course, as well, to have a diverse shared ownership and more easily. So it's coming. It's just about how fast, I guess. And ultimately your car will be an NFT as well, or it'll be nested NFTs with dynamic NFTs underneath. Every time you change a wheel in your car, you'll change a little NFT in the nested NFT that you hold for your car. This is everything will come on, but yeah, I think it'll be a bit slow.
I think this next question is for you, Jeff, because I think you're certainly well more advanced than I am, because my knowledge in this is literally zero, and it's really a very interesting topic that a lot of people are asking us about now, is the role of AI agents and in crypto, particularly DeFi. I saw a tweet today from from an art collector where a AI agent had basically bought a piece of art, and then and they were just astounded. But how do you see AI agents playing a part in crypto, whether it be obviously DeFi being the most obvious ones, unless they find a way through to CeFi platforms. But how do you see AI agents playing the growth in crypto?
Yeah, it's super interesting. I mean, I'm only just starting to look into it or think about it really, but it's amazing that it enables a decentralized, or sorry, a permissionless crypto wallet basically enables or can facilitate an AI agent to become an actual economic actor. Right? So as you're talking about, buying a piece of artwork, and I think the guys on the Bankless podcast were recently talking about that they received a tip from an AI agent. So which raises the point that AI agents can earn money. For example, there could be an AI agent trading bot. It can earn money and it can pay money, and you could end up working for an AI agent. So crypto enables that, and permissionless wallets enable that. The other thing is, and I think I'm not personally not fully across it yet, but virtuals is obviously huge at the moment. It's risen up the ranks. I think it's worth about $3 billion now, up about 3,000% this year, ranking about 50 on the capital ranks. So, and I think you can basically tokenize those AI agents as well, right? So you can have an AI agent that's created and trading for you, earning money, and then we can tokenize it and we can share and participate in the rewards coming from that AI agent as well. So that's it gets pretty interesting, and there's some risks to think of as well.
Yeah, I mean, one for you, Kim. I mean, coming up to 8 years in crypto now, I still get incredibly nervous dealing with wallets and DeFi. I think I sit there and try to double, triple check and quadruple check the address and send $1 transactions before I send the rest. And I mean, it's super scary. And as an industry, we need to totally change improve the UI UX around wallet management. I mean, do you think AI can make DeFi more friendly, or crypto usage more
Definitely.
friendly?
Yeah, I think definitely DeFi, as you say, right? Even now, we still seem to be, working on version 1, right, on some of these UIs in terms of executing on these AMMs. So I think AI agents, will change the way that we interface with DeFi in a way that would make it more user friendly and a little bit more seamless, right, compared to what we're used to, M2 on the CeFi side. So there's definitely a lot of work that is needed in order to improve that experience. So I think AI can play a big part in things like risk management, liquidity pool management, managing yield farming, etc. So there's a lot of upside.
Yeah.
Yeah.
There's a few risks to consider as well, like what sort of rules do the AI agents have to conform to? Are they subject to market manipulation rules? Are they subject, can they spoof the market however they like? And who's responsible? Who owns them? So if an AI agent goes out there and causes trouble, right,
No.
who's responsible?
Yeah, I think we need to get a couple of AI agents on this podcast. We can ask them. So, Kim, Kim, Jeff, thank you so much. It's been a lot of fun chatting with you guys, and hope the listeners enjoyed this.
Yeah, thanks so much. Thank you, everyone.
Thanks, everyone. Bye.
Pleasure.